Well, in this morning's U.S. Bank Economic 360, we're talking about the ebb and flow of economic conditions locally, nationally, and globally. Slow growth and low inflation, while not ideal for many, are actually in the sweet spot for many companies in terms of their growth outlook. So how does this work, and what do conditions suggest about the period ahead? For perspective, we turn to U.S. Bank's Jim Russell. So, Jim, we've had slow growth and a certain amount of regulatory control here. First of all, it's great to have you with us, as always.
Thank you, sir.
What do you think, how does this benefit companies? Which ones benefit and which ones don't from this environment?
It's a great question, Brian. You know, the economy goes up, it goes down, it grows slow, it grows fast, interest rates up and down. So things bob around. Conditions clearly bob around, but as you might be surprised to learn, certain companies actually do well in a slow growth environment. You can see that the stock market is divided into 10 economic sectors. Healthcare, consumer discretionary, telecom and utilities are listed on the page here. You can see that healthcare and consumer discretionary have done especially well here. Healthcare, because of regulatory change and the pending Affordable Health Care Act, is hugely positive for the sector. We'll tell you that consumer discretionary is all around housing and autos. The low interest rate environment that we're seeing right now, very beneficial to both of those areas. Now, what you're going to see is the Affordable Health Care Act, again, very key in many companies' futures, maybe less so in others. And that is, we're already starting to see some changes in health care plans, UPS in particular, that are going to be linked to the Affordable Health Care Act. Historical low interest rates, very helpful to, again, consumer spending and housing. Continued strength in housing is expected, so we continue to see strength into 2014 there, and again, improving U.S. growth as well.
Jim, would you say that smaller or larger companies benefit more from this environment?
You know, that's a very interesting question. It depends on where the growth is. If we have strong domestic growth, which is indeed what is out in front of us right now, the smaller companies tend to do a bit better. But you can see that in June or so of this year, small companies started to pull away from large companies. The small companies are, the proxy is the S&P 600, doing much better than the larger company-oriented S&P 500. Again, they were trading together until about June. In June or so, Brian, we started getting some very clear economic data. Hiring improving here in the United States, jobs improving here in the United States, profitability also strong in the United States, maybe less so globally. So larger companies, of course, have global exposure. Smaller companies are usually more domestically oriented, hence the performance differential.
As we look ahead into 2014, what do you see happening, and what companies do you see benefiting from that?
Well, we do see a higher growth rate as we move forward. We think that 2013 will be about a 2% growth period for the United States, about a 3% globally. We see both of those numbers ratcheting up maybe next year. 3% growth in the United States, maybe 3.5% to 4% growth globally. We think that technology, energy, and consumer discretionary areas of the economy do pretty well. Hence, we think that those are the areas the stock market will favor.
Some complicated issues. Thanks for clearing them up for us. We appreciate you, Jim, and U.S. Bank.
Thank you, sir.